Welcome to Finance Trice, the world's modern broadcast hub for all things finance. From investing strategies to economic updates, from crypto insights to real world money lessons, every broadcast is designed to help you think smarter, plan wiser, and grow.
Imagine stepping into a cinematic scene, maybe something meticulously clean, a little ominous. We're in a picture-perfect American suburb. We zoom in on two neighboring houses, identical in every detail, split by that classic white picket fence. Inside these homes live Mark and Dave. They're both 30. They work at the same company, same job title, pulling in the exact same $75,000 salary. They even drive the same gray sedan. On every single visible metric, they are indistinguishable.
But here's the twist. Here is the invisible financial wall between them. Over the next 30 years, just to live the exact same life, Mark is going to pay $250,000, $250,000 more than Dave.
$250,000. That money isn't lost to, bad stock picks or a gambling habit. It is handed directly, systematically to banks, to lenders, and to insurance companies.
It's lost to an invisible tax, a tax levied by a secret three-digit number. See, Dave's credit score is a 760. Mark's is, well, it's hovering around 640.
And that 120-point difference is the entire mechanism. It's the silent transfer of wealth from one house to the other.
Right. I mean, think about it. We obsess over income tax, sales tax, property tax, all the visible burdens. But we are completely defenseless against what we're calling the credit tax. And it is, arguably, the single most aggressive destroyer of wealth for the average American family.
And if you're listening right now and you're the person who works hard, you pay your bills on time, you feel responsible, but you're still terrified of that score, terrified it'll drop because you put a new fridge on your credit card, this deep dive is for you. Today, we are exposing the score for what it actually is. It is not a measure of your moral character. It is certainly not a measure of your wealth. It is a surgical instrument designed for one thing, to measure exactly how profitable you are to the banking system.
And our mission today is to give you the strategic defense, the insights, the legal context, and the step-by-step guide to dominate this system. We want to make sure that you are the one keeping that $250,000.
Okay, let's unpack this. Because the history here is where it gets really interesting, where the myth-busting has to start. We've all been sort of conditioned to believe the FICO score is this ancient, fundamental pillar of finance.
It has that weight to it, doesn't it? Like it's always been there, like compound interest or something.
Exactly. But the truth is, the FICO score is younger than Taylor Swift. It was introduced in 1989. Just 35 years ago, the mechanism that now dictates where you can live and what you can drive. It just didn't exist.
Before FICO, lending was all done by humans. A loan officer at a bank would look at your application, verify your job, and make a judgment call.
And we have to be really clear here. That old system was deeply flawed. It had massive, massive problems with explicit bias, with racism, with things like redlining. It was awful in many ways.
Absolutely. But the key thing to understand is what FICO did. It didn't get rid of bias. It just swapped that messy human bias for something else. It swapped it for algorithmic ruthlessness.
That's a perfect way to put it. And it gets to the why. Why was it even invented? It wasn't to help you get a loan or to make things more fair. It was a corporate invention for one reason: the securitization of debt.
Let's just break that down for a second. Securitizing debt. Imagine a bank has thousands of mortgages. To make the big money, they want to sell those loans off their books so they can lend more. Securitization is just bundling all those loans, mortgages, car loans, you name it, together into a package.
A package they can sell to investors anywhere in the world.
Exactly. And an investor in Tokyo can't read the personal file of, Mark in Ohio. They need a quick, universal number to judge the risk of that whole bundle. The FICO score was that number. It made debt instantly tradable.
And in doing that, it created what is basically a financial caste system. Overnight, on one side you have the primes, the Daves of the world, 760 and up. Banks have to compete for their business with low rates. They basically get cheap money.
And on the other side, you have everyone else, the near prime, the subprime, the marks. They're seen as profitable because of their risk. So they're forced to pay a surcharge, that credit tax, on almost everything they buy. It's a system designed to just accelerate the wealth of people who already have access to it.
Okay, it is time to get out of the abstract and into section 1, the math of destruction. Because when we start looking at the actual numbers, the amortization schedules, this is where it becomes genuinely terrifying. Let's start with the biggest purchase most people ever make, a home.
Right. Let's go back to Mark and Dave in that $400,000 house. We'll use today's rates just to make it clear. Dave, with his 760-plus score, he walks in and gets the best rate available. Let's call it a hypothetical 6%.
Now, Mark, sitting at a 620, the bank sees him as much riskier, but they're not going to deny him the loan. That's leaving profit on the table. Instead, they just apply the credit tax, the risk premium.
And that premium might bump his rate up by just 1.5%. So he goes from 6% to 7.5%. Now, on the surface, 1.5% sounds kind of minor, right? Almost trivial.
Yeah, you wouldn't think it's a huge deal.
But on a loan this big, for 3 decades, that small percentage isn't so small. When you run the amortization schedule on that $400,000 mortgage, that trivial 1.5% difference adds up to roughly $120,000 in extra interest payments.
$120,000. That's the cash transfer right there. Think about that. Mark is buying the same drywall, the same roof, the same patch of grass as Dave, but he's paying a $120,000 fine for having a mediocre number attached to his name.
But that's not even the real cost. The true tragedy, the thing that separates people who get this from people who don't, is the opportunity cost. That $120,000 that Mark was forced to pay the bank, that's money he could not invest.
Right.
If he had been able to invest that difference, even conservatively, over 30 years in, say, an S&P 500 index fund, that money would have compounded into well over $500,000.
$500,000. So the real cost of a bad score isn't just the extra interest today, it's the complete destruction of his future retirement, his freedom.
It's systematic. And it doesn't stop with the house. Think about the second biggest purchase.
Yeah.
The car. Let's say they both buy a $30,000 car and finance it for 5 years.
Okay, so Dave, with his 760, he's getting the best rate, the promotional rate. Maybe 3.5%, 4% in today's environment?
Say 4%. Mark, with his 620 score, is deep in subprime territory for auto loans. He's getting hit with a rate that could easily be 10%, 12%, maybe even higher.
So let's say it's a 12% rate for Mark. That's an 8% difference. Over 5 years on a $30,000 loan, that adds, what, another $4,000, $5,000, $6,000 in interest?
About that, maybe $6,000. And you do that twice as they replace their cars over the decades, you just added another $12,000 to Mark's bill. When you start adding up all the financial friction, credit cards, personal loans, everything, that $250,000 estimate starts to look very, very conservative.
And if that systematic wealth extraction wasn't, disturbing enough, this is where the story mutates. This is where it gets into, like, Black Mirror territory. The score is no longer just a lending tool. It's become this universal reputation score, a judgment of your value as a human.
This is exactly why we call it a tax on your very existence. The system figured out the score is a powerful predictor of overall behavior, and other industries jumped on it. The most absurd and clear example is car insurance.
Right. The insurance companies claim that their data, their actuarial tables, show a correlation between low credit scores and a higher chance of filing any kind of claim, not just for a crash, but for anything.
So they say a low score means you're a higher risk, period. It doesn't matter what your actual driving record looks like.
And this is the poverty premium in action. The studies on this are just staggering. They consistently show that a driver with a perfect, clean driving record, but a poor credit score, will often pay double the premium of a driver with a DUI conviction on their record, but a perfect 800 credit score.
Let's just pause on that for a second.
Yeah.
The system, through its pricing, is openly stating that it trusts a documented drunk driver who pays his bills on time, more than a safe, sober driver who had a tough financial year 3 years ago. The score literally overrides physical reality. It's insane.
It really is. And the friction just spreads everywhere. Landlords use it to decide if you can rent an apartment.
So a lower score pushes you into either higher cost housing or lower quality neighborhoods.
And utilities. Just turning on the lights or the internet. The companies demand security deposits, sometimes hundreds of dollars, from people with lower scores. That's cash that a financially strapped person needs the most, and the system forces them to lock it up just to get basic services.
But maybe the most frustrating part is employment. Employers in finance, government, defense, any job with financial responsibility, they run credit checks. They use it as a proxy for your character, your reliability.
So you could be the most qualified person for a job. You ace the interview. But maybe 5 years ago you had a medical emergency and you missed a few credit card payments. That one event, that 7-year stain on your report, can get you flagged as irresponsible and cost you the job that could have been your path to recovery.
It's a trap. The score becomes an obstacle to the very financial stability it supposedly measures.
All right, let's move into Section 2, because we have to talk about the rigged rules of the game. we need to really dig into what the score doesn't measure. This is probably the most critical part to understand.
This is the central myth we have to bust. The credit score is not a measure of your wealth. People just assume high score equals rich, low score equals poor. The reality is, it's so much more cynical than that.
The paradox of cash is the perfect example. You could have, I don't know, $10 million in a bank account. You bought your house with cash. You drive an old car you paid for. You use a debit card for everything. But if you've never taken out a loan to the credit algorithm, you're a ghost. You might even be unscorable. You're irrelevant because you're not profitable.
And then there's the flip side,
Yeah.
the paradox of debt. You could be living paycheck to paycheck, drowning in credit card debt. But if you are constantly making those minimum payments on time, you're actively participating in the debt cycle. To the system, you're a superstar. They love you.
So what it's really rewarding is churn. It rewards constantly borrowing and repaying. And maybe the most backwards part is how it punishes you for paying off certain loans too early.
Yes, this is a big one. Anyone who's paid off a car loan or a student loan has probably felt this. That amazing feeling of making the last payment. And then you check your credit score, and it's dropped 20 points.
It's so frustrating. Why does that happen?
Because a big part of the score, about 10%, is something called credit mix. The algorithm wants to see that you can handle both revolving credit, like credit cards, and installment loans, like a mortgage or a car loan. When you pay off that car loan, you close an active installment account. Your mix becomes less diverse, and your score takes a hit.
So the system is basically saying, hey, we liked you better when you were paying us interest every month.
It's a loyalty program for debt slaves. That's exactly what it is.
So let's get into the specific mechanics, the actual weightings, because ignorance here is just incredibly expensive.
Absolutely. Two factors make up 65% of your score. If you master these two, you're most of the way there. First and most important is payment history. That's 35% of your score. It's totally binary. You either paid on time or you didn't. One single 30-day late payment can crater your score, and it stays on your report for 7 years.
7 years. So that's the foundation. If you mess that up, nothing else really matters.
Nothing. It's the #1 predictor of future default in their eyes. You have to protect this part of your score viciously.
Okay, so that's 35%. What's the next biggest piece?
The next 30% is credit utilization. This is where it becomes a game of optics. Utilization is just the ratio of how much credit you're using compared to how much total credit you have available.
Let's do some numbers here to make it clear.
Okay, say you have one credit card with a $1,000 limit, and you spent $500. Your utilization is 50%. To the algorithm, that looks really bad. It smells fear. It looks like you're maxed out and dependent on that credit. Your score goes down.
Right. But now let's say you owe the exact same $500. The debt is identical. But over the years, you've asked for credit limit increases, and now your total limit is $10,000. That same $500 debt is now only 5% utilization.
And the algorithm loves that. Your score shoots up. The trick here is that you didn't pay off a single dime of debt. You just changed the denominator. You changed the total amount of available credit. The system rewards looking like you have access to tons of credit that you have no desire to use.
So the goal is to keep that utilization ratio as low as possible. Under 30% is okay. Under 10% is great.
Under 10% is where you start to see real acceleration in your score.
And this leads right into something you call the invisible inheritance of inequality, the authorized user hack.
Yes. This is one of the clearest examples of how financial privilege is passed down through generations, almost like a genetic trait.
So how does it work?
Okay, think about Dave, our prime borrower. He's got an 800 score, maybe a credit card he's had for 20 years with a perfect payment history. He simply adds his 18-year-old kid as an authorized user on that card.
And the kid doesn't even have to use the card, right?
They never have to touch it.
Yeah.
But the entire history of that account, the 20 years of on-time payments, the high credit limit, the age of the account, it gets copy-pasted directly onto the kid's brand new credit file.
So the kid wakes up at 19 years old with what, a 780 score?
Easily.
Yeah.
A 780 score and a 20-year credit history. So when they walk into a car dealership, they're seen as a low-risk, established borrower. They get the 0% financing deal.
And now contrast that with Mark's kid. If Mark has bad credit or no credit, his kid starts from scratch. That kid walks into the same dealership and is seen as a huge risk. They get hit with a 15% predatory loan.
And that's the mechanism. It's a closed loop. The children of the wealthy get a massive head start, a guaranteed low cost of living, while everyone else starts in a financial hole they have to dig out of for years.
Which brings us to Section 3, hacking the game in pragmatic defense. Let's talk about what happens when things go wrong. Let's talk about credit repair. Most of the industry is a scam, but the legal principle they use is very real.
Very real. And it's all based on a piece of federal law from 1970 called the Fair Credit Reporting Act, or the FCRA. This law gives you rights. It says that any information on your credit report must be 100% accurate, and this is the critical part, 100% verifiable.
And that's the loophole.
That is the loophole. If you dispute an item on your report, say a late payment or a collection account, the credit bureau has 30 days to verify that debt with the original creditor.
And if they can't?
If they can't provide the complete, verifiable paperwork to prove the claim within that 30-day window, they're required by law to delete it from your report, period.
So to be clear, you're not proving that you paid the debt. You're proving that their paperwork is messy.
You are exploiting administrative incompetence. It's a legal strategy, not a moral one. Look, the wealthiest people and corporations in this country use legal loopholes to save billions in taxes. You have every right to use the legal loopholes available to you to protect your own money.
Okay, so this brings up the philosophical debate, right? The cash-only approach is just opt out of the whole system.
And we respect that. If you can truly live your life, buy a house, cars, everything with cash, you've won the game. But for 99.9% of people in America, trying to live with a zero credit score is just choosing to play life on hard mode for absolutely no reason.
Yeah, you'll be denied apartments, you'll pay more for insurance, you'll face friction at every single turn. It's exhausting and it's expensive.
The pragmatic move is not to boycott the score. It's to manipulate it. You have to treat it like an annoying video game that you have to speedrun. Get your score to 760 as fast as you can to unlock the cheap interest rates, and then you're out of the penalty box for good.
Okay, so let's get into those practical strategies, the step-by-step guide to actually dominate the score.
Strategy 1. Automate everything. This is pure defense. This protects that 35% for payment history. You need to set every single bill you have to autopay the minimum amount. This is your safety net.
The minimum. Why not the full balance?
Because you can always go in and pay the full balance manually before the due date, which you should do to avoid interest. The autopay on the minimum is just there to ensure you never, ever get hit with a 30-day late fee because you forgot or you were on vacation. You're taking human error out of the equation.
That makes sense. Okay, what's strategy 2?
Strategy 2. Play the limit game. This is your offense. It targets that 30% for utilization. Every 6 months, like clockwork, you call your credit card companies and you ask for a credit limit increase.
Even if you don't need it.
Especially if you don't need it. Most of the time, the soft pull doesn't hurt your score. By constantly increasing your total available credit, you're building a huge buffer for your utilization ratio. So an expensive month doesn't tank your score.
Okay, that's a good one. What's next?
Strategy 3. The anchors of reputation. This protects the 15% of your score that's based on the length of your credit history. You must never, ever close your oldest credit cards, even if you hate the bank, even if you haven't used it in 5 years.
Why not? If you don't use it, why keep it?
Because when you close that account, you erase all of that history. It's like deleting the first 10 years of your resume. The average age of all your accounts instantly drops, which makes you look less experienced and more risky to the algorithm. Those old accounts are your anchors.
So what's the trick? Just buy a pack of gum once a year on it.
Exactly. Buy coffee, a pack of gum, anything, paid off immediately. Just keep the account active so it keeps reporting that long, perfect history.
Okay, so we've covered the big ones. Any advanced strategies?
Yes, 2 more. Strategy 4 is to leverage your credit mix. Since we know the score likes to see both revolving and installment debt, if you only have credit cards, you can strategically add an installment loan. The easiest way is a credit builder loan from a credit union. You're basically paying them a small amount of interest to report a perfect installment loan history for a year, which can give your score a nice boost.
And the last one, for when things have really gone wrong.
Strategy 5. Negotiate a pay-for-delete. If you have an account in collections, just paying it off doesn't remove the negative mark from your report. It just changes it to paid collection, which is still bad. The strategy is to contact the collector before you pay, and you get an agreement in writing that if you pay the debt, they will completely delete the entire entry from your credit report. You use your payment as leverage to erase the damage.
So as we wrap this up, what's the final takeaway? What does this all mean?
It means the credit score is not a reflection of your self-worth. It's not a moral judgment. It's a game token. It's a VIP pass. You need to get cheap interest rates so you can build a life in this country.
And you have to protect that token viciously. Not because you care what the bank thinks about you, but because you refuse to pay the poverty premium. You refuse to hand over that extra $250,000 that belongs in your retirement account, compounding for your freedom.
Right. The goal is to get so organized and master the algorithm so well that you become unprofitable to them. No late fees, no high interest balances. You become so trusted that they have no choice but to give you their best rates. That's when the power shifts back to you.
So here's the final call to action for everyone listening. We know that about 1 in 5 credit reports has an error on it, an error that could be costing you thousands of dollars. So this week, commit to pulling your official reports and disputing every single error you find. Use the power of the FCRA. The banks are literally banking on our ignorance and our apathy. Let's start giving them our money.
And as a final thought to leave you with, think about this. If FICO was invented in 1989 to quantify risk for debt, and it mutated to control insurance, housing, and jobs, what's the next iteration?
That's a scary thought.
If the credit score was the invisible tax of the 2000s, what's the invisible tax of the 2030s? Will it be an algorithmic reputation score based on your social media data, your purchasing habits, and how quickly can we learn to game that system before it completely dictates our lives?
A question to think about. If this deep dive opened your eyes, share it with someone who might be playing this game with a blindfold on. We'll see you next time.